What if I told you your life insurance policy holds the key to an unlimited source of cash and be able to use that money over and over again, like a Swiss Army knife deployed into alternative investments along the way while you're in the working years? Well, today we're going to talk about using a life insurance policy like an infinite bank account. Okay, folks, let's get into infinite banking. It's important to note that while infinite banking can be a powerful financial strategy, it requires a long-term, not short-term, a long-term commitment and a thorough understanding of life insurance policies. Additionally, there are risks involved, such as the high cost of whole life insurance compared to term insurance and the potential for policy lapse if premiums are not paid. Remember, folks, and please write this down, consulting with a financial advisor or insurance expert is recommended to assess whether this strategy aligns with your financial goals and circumstances. And stay tuned to the end, because if in fact you want to have a direct connect with that, we'll be able to provide that for you. So as we talk about infinite banking, it's important that whenever you see videos like this or any other videos and they talk about, hey, if you want to sit down and meet with us, you need to understand the policies that they're showing to you, because, and we'll get into it throughout the rest of this video, they could be using the same language I'm using, but give you a policy that does not align with what this strategy is, and it's real important you I dot and T cross along the way. All right, folks, we're going to get into 5 separate points. Number 1 is going to be choose a whole life insurance policy. Start by selecting a whole life insurance policy. This type of policy not only provides a death benefit, and that's really based on your future value if you do it the right way, but also accumulates cash value over time. The policy should be with a reputable insurance company that offers favorable terms and conditions for borrowing against the cash value. This is according to NerdWallet. So let me play a little bit. What we love to do when we sit down and analyze how to play in the space of using cash value whole life insurance, we want a reputable, mutually owned life insurance company that is non-direct recognition. Now, what that really means is when you borrow money from a policy, and I'll talk about that later on, you want to make sure that your interest and your dividends isn't affected. That is what the non-direct is. And then obviously a mutual company is different than a stock company. A mutual company means you mutually own the company, whereas a stock company means that, hey, you're not first on the list, you're second, third, or fourth if something were to happen to that company. More to come on that, but stay tuned with the rest of this video. And remember, choose wisely, I dot and T cross along the way. So as I explained, and I'll do this real simple, the difference between a mutual and a stock company. A mutual company is where each and every policy holder, me, you, and everybody else within that company, owns a piece of the company and gets rewarded with a dividend. A stock company means the shareholders are in line before people like us that have policies with those stock companies. The shareholders get the dividend first. So we like mutual companies where we're mutually owning the company together. And then the step further would be the non-direct recognition, because if we're going to borrow money from the policy, we want to make sure the dividend and the interest is not interrupted at all. So as we get into number 2, overfund the life insurance policy. This is what separates the men from the boys, the women from the girls. Infinite banking involves contributing extra funds to a cash value life insurance policy and using it as a line of credit. Contribute more than the minimum premium required to the policy. This extra funding accelerates the growth of the cash value within the policy, creating a larger fund with which you could borrow in the future. Once again, this is according to NerdWallet. Now remember, this is where it's important you have a direct relationship with an agent that understands everything that we're talking about, because if you're going to have a baseline premium, let's say it's $1,000 a month, I'm making up a number, and you want to dump in $100,000, which ties into that extra money, you got to be careful that $100,000 does not make this a taxable event. More to come in the one-on-one meetings on that, but you want to make sure that whatever your baseline savings is, the initial death benefit, whatever that dumping is going to be, stays in line and doesn't break the threshold of a modified endowment contract, aka a MEC, that would make it taxable. And these are longer conversations. You should never watch a 30-second video and decide that you're going to become your own bank. And this is why we want to take the time and explain this to you throughout. Stay tuned until the end. Number 3, accumulate cash value. Allow the cash value in the policy to grow. Whole life policies earn cash value at a guaranteed rate of return over time. The objective is to build up this cash value to a substantial amount before you start borrowing against it. NerdWallet talks about that as well. So let me go back to the last example where I talked about if you're going to save $1,000 a month, but then dump in $100,000. Watch. And I'm going to say this. Watch me nay-nay. If you are doing it where you're putting in $1,000 a month, right, and the contract is done the right way and it allows you to dump in 100 grand, I'm going to give you an approximate right now, but this is where it gets fun. And this is where I want you to think, and your normal insurance agent is not going to like this because they're not going to make a lot of money. Here it is, $1,000 a month, right? After the first month, you pay $1,000 and you say, you know what? I found another investment I want to do. So I want to dump in 100 grand. You wire in that. There's certain carriers that let you wire in the $100,000. So you made your $1,000 payment. A week later, maybe 2 weeks later, you wire in another 100. So before your next $1,000 payment comes out, you could actually leverage the 100 you put in to the tune of about $85,000 to $90,000. So I want you to think about that. You put your first 1,000 in. The second 1,000 is due 30 days later, but in the middle, you dumped in 100 and you took out 90, 85 or 90 to put into an investment piece of property. I'm not suggesting this. I'm just giving a hypothetical example that gives you 4 rates of return. When you buy rental real estate, you get cash flow, you get a mortgage interest write-off, you get to depreciate it, and oh, by the way, you're buying it today, so it's worth more in the future. I'm not talking about if you buy it inside an IRA, by the way. Those 4 rates of return, if you combine it with the money that was in the policy that was dumped in, and then use that money as a down payment, you now get dividends, interest, and oh, by the way, have your renter pay back the policy, and you get 7 rates of return in that scenario, hypothetically, as you use the life insurance as cash value to buy a piece of rental real estate. Take that and rewind it back. I told you I was going to nay-nay. I just gave you $1 million worth of gold that's going to save you money over time and lost opportunity cost, and eliminated about 99% of the life insurance agents that are going to come your way. Number 4, borrow against the policy. I just spoke about it, but let me just give you a quick definition, and I'm going to tie it all together. Once a significant amount of cash value is accumulated, you can start to borrow against the policy. However, I just explained how you can expedite it, how you can turn decades into days. This step involves taking out loans from the life insurance policy rather than through traditional lenders. These loans are usually at a lower interest rate and offer more flexibility as far as how you want to repay it back according to NerdWallet. Now check it. We just talked about it. You put 1,000 in, you dump in 100, you take out 85 or 90 before the next 1,000 goes in. Watch. You get to decide on how you're going to pay it back. There is going to be a loan interest. Ideally, you'd like the arbitrage to be in your favor. You're like, Rob, what does that mean? Arbitrage, you want to make sure that when you're borrowing the money, the dividends and interest inside the policy is still earning more than what you have to pay in interest back into the policy. You could work all this out with your agent. Have you ever called an insurance company to get access to your cash value and you get put into a, no offense, another country to get your money, and it takes weeks in order to get the check? So it's important you have a good relationship with your agent, because you want to make sure if you're utilizing this money as a, infinite banking, become your own bank model, that you're able to move it in and out in a timely fashion. So like I said, if you make a payment for $1,000 and you want to wire in money, you want to make sure you could do that pretty fast. More importantly, to take it out, you want to make sure you can get it back in 2 or 3 days. There's online things you could do with some of these carriers, but the agent being able to facilitate that is real important. I know for me in the past, there was other carriers, I won't mention names, but sometimes I would get rerouted to a person in another country and not get my money for 3 or 4 weeks. You want to avoid that at all costs. That's an important thing to understand when it comes to your money time freedom. Number 5, repay the loan strategically according to insuranceandestates.com. When you take a loan against your policy's cash value, make sure to repay it strategically. Even though you are borrowing from your own policy, repaying the loan is important to maintain the policy's value and to ensure that the death benefit isn't reduced. Proper payment of these loans can lead to a cycle of borrowing and repaying, which is central to the concept of infinite banking. Yes, here it is, folks. You borrow the money, you have your rent to pay back the policy. You borrow the money for your own business, you have the revenues to pay back the policy. You get to create your own amortization schedule on how you pay back the money. You could chunk it, you could pay it quarterly, you could pay it monthly, any way you decide to do it. It's important that you have that in place, though, before you borrow the money to make an investment, have an idea what the investment's going to earn you, so you know how to strategically pay back your policy. If you rinse and repeat this model, you'll be amazed 3, 4, 5 years later, especially if you're overfunding, how decades turns into days. A lot of different alternative investments are starting to give you passive income in all kinds of different directions. Thank you for spending time and checking out this video. And we just went through a lot. We went deep into whole life insurance. And yes, it's like driving a rocket ship if you're not careful. You want to make sure that your co-pilots know exactly what to do. And if you want to learn more about this with no obligation, go ahead, click the link below. One of the team members here at Epic will take you through that educational process so you will feel fulfilled and fully understanding on what to do, how to ask the right questions, and how to put yourself in a position to prosper. And thank you once again for checking us out. Don't forget to like, share, and subscribe.